Look, Sarepta disappointed everybody. The whole biotech community hates them now. They're launching a drug. They said it's going to be great. And then a quarter later, they said, well, actually, we fucked it up. So, they're in the doghouse, but that's our opportunity. I don't know about the 80-20 rule. I think that I've talked about this with a lot of friends over the years, hedge fund managers and so forth, performance attribution and how much effort you put into stocks. And one of the things we're doing at Godel is we're going to help you and help your firm, but even you as an individual, but particularly if you're at a firm, look at the distribution of time you spent on stocks. So most people will spend 80 or 90% of their time on a single stock or something like that when, they their marginal time is not going to benefit them. More time more time does not help you when you have studied a company at some point. The marginal return won't get you there. So yeah, there's some Pareto optimal amount of time that you want to spend, but I feel like IonQ is still juicy short. I'm sorry, D Wave is still a juicy short. I mean, they're all good shorts, but you get my point. It's still up 17%, so it's still. I think D Wave will be down today. I said that in Godel chat earlier. Must have felt crazy when it was up 30%, but I think it will be down today because they literally announced bad news today. It does not take a genius to figure that out either. That's the fun thing about investing is that on the one hand, it's accessible to everyone. On the other hand, it drives smart people crazy. Because really smart people, I guess I put myself in that category, but even people smarter, like I'm talking about people who are like IMO winners, super programmers, some of the guys I work with, those types of dudes. I would say if I'm maybe a 9 out of 10, these guys are 10s out of 10s. My girlfriend's a 10 out of 10. MIT, all that stuff. International intellectual competitions. I was just beneath that. Investing sucks for those people because it's just really hard. You're looking at a market that of uninformed and crazy participants. As a group, they get it right generally, but you just it fries your nerves looking at people getting it wrong. And the funny thing is, people will get it right with time, with more information. But you know the truth now, and you want the price to change now. And you have to, just get out of, that mindset where, the moves the moves that are wrong are your fuel. They are literally your reactants, I guess, or like your starting ingredients for what you're trying to do. You cannot win without the dumb people. You can't win without people making bad investments. Because if everything were priced correctly, there's no alpha for you anyway. So you want the Bagahantras. You need them. But the problem is, the paradox is, the more they exist, the more it infuriates you. And so you just have to find a way to, just get your head in a space where emotionally it doesn't wreck you, but you're still disciplined enough to recognize that the market is not perfect. Poker is similar. Poker is extremely similar to investing. much more so than chess. Chess is a fun example because in general the information symmetry is closer, I think, in chess. Poker, you don't, there's plenty of information you don't know. And while in investing there's information you don't know, it's generally future events, right? Uh, I think it's closer. The information side is closer to chess because yeah, farming had a good quarter. It's up 16%. That's one of our holdings. I think that I don't think chess is the opposite of stock trading, but regardless, we can talk about that later. I think that the blackjack, blackjack is a good example too. They all have some similarities. They all have some differences, but in chess, all the information is revealed to both players at the same time. In the markets, all the information more or less is revealed to everyone at the same time. You're reading the same 10Q I'm reading. You're listening to the same conference call I'm listening to. Yeah, exactly, Mark. Mark's got it. There are parallels all over the place. Yeah, look, the convert is not kind of a non-event for him, unless you want to interpret it as they looked at their stock price and said, "Oh, let's sell some." And a convert is partially selling equity, right? But in any event, yeah. Yeah, nobody can know future cash flow or earnings easily. Otherwise, we trade stocks like they're bonds, which they're not. And even bonds, they're not always 100% predictable either. But forecasting is an art. It's an art form. Uh, there's ways to do it that you pick up over time. You pick up a little bit of technique. It's kind of an art form. Anyway, yeah. So Ken, that's one of the things that I had this like period of hyper growth as an investor in 2009, 2010. That's one of the most important concepts in finance is when you look at the discount rate as the risk-free rate, and then you start to gain a little bit of superpower about how you think about businesses. That's a pretty advanced concept. Um, I do think a lot of finance at that level is very philosophical because you can look at it that way, and then you can also not look at it that way at the same time. You're not bound by one philosophy, and I think it's great because you can understand that, like for drug companies, for example, the discount rate for almost every drug company should be close to zero once you have the drug, because patients don't stop taking a drug. For example, once you're approved and you're selling, you have risk to executing a commercial plan. That there's no doubt about that. But in general, if the commercial plan's straightforward, and maybe if you're a year or two into your drug launch, there's basically no risk. Um, there's sometimes a risk that you could have yeah, I might buy some ADMA here. You could have a competitor drug come in or something like that, but you will collect the cash flows, right? And when you collect the cash flow, your whatever you discounted it by last year, it doesn't matter because you collected it, right? And sometimes I say this is the desert island versus the uh, Russian roulette or Monte Carlo. When you play Russian roulette, it's a single outcome from a sampling. You will either be dead or the barrel will spin and you won't. And um, you can play that game as many times as you want. But Desert Island is you get some people say, well, you get to go, you're going to be on a desert island for the rest of your life. You get to take one book with you. What book do you take? Well, sometimes in investing, that's a scenario where it's like, no, you get one chance to get this right. You got to get it right. Like cassava, for example. The cassava short was a desert island kind of outcome. Being wrong there was like a huge risk of ruin, and being right was the only option. And at least in that scenario, of having a huge bet against it, for example. So in general, you don't want to be on the desert island very often, but it can be very profitable, like the pound trade for Soros or this short quantum trade we're setting up. So I don't know. I think that this is a citadel. I think Ken Griffin has some thoughts about this too. There's a lot of ways to think about risk in general, and again, this gets very, very, very philosophical. Because you're really talking about opinions. There's no right or wrong answer. If Buffett says, look, the Coke is good for it, there's no doubt in my mind about the Coke cash flow. What does that mean? Okay. Well, we can agree that $1 today is always worth more than $1 tomorrow for various reasons. So we can agree that equity is riskier than many things. But are those Coke cash flows riskier than a treasury bond? I don't know. That's a tough one. It's not that the textbook answer is, of course it is. It's equity, not debt. And it's a company. Anything can happen. It's a business. But at the same time, in reality, Coke's going to meet, more or less meet their earnings estimates. Almost anything, almost nothing, could derail that, at least for the next year or two. And so, what is the point of discounting cash flow if you're going to receive it? Now, you might say, look, I can put this money to work somewhere else. But also, if you're Buffett or a successful investor, maybe you're actually rate limited by investing opportunities. So for you, you're more interested in getting the cash flow than you are discounting it. And the certainty of the cash flow that'll always be here is pretty important. So for example, if you have a business that makes $100 million and you take every year, and you take that money and you buy Coke, and Coke's paying you a dividend, and you keep buying Coke with that capital that you get from your business, over time, over enough time, especially if you have a really long time frame, you're going to own a big part of Coke at some point. So this kind of philosophy I've seen employed by some older guys I know, and it can work wonders, But you generally have to have a business that has cash flow. A lot of us are trading a book. We have cash in an account. We're trying to make the account value go up. That's really all there is to it. And the cash that's in our account has come from either some temporary source, some windfall maybe, or it's not very large and it's not going to increase very much. But that doesn't mean that or if it's your job, for example, and you can't pay attention to your investment portfolio because your job takes up most of your time. But if you have a business that's generating cash flow, it's almost certainly can guarantee you, amazing results if you invest the proceeds of the business profits. Almost nobody does this.